Good morning and welcome to this Monday, December 16th edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. I do want to just mention briefly that we do have Market Vision 2020 coming up. That is going to take place on Saturday, January 4th. John Murphy will be there as our keynote speaker. A number of my stock charts colleagues that I've written alongside for the last several years will be joining us, giving you all of their collective outlooks and what they see heading into 2020. I think it is going to be the best online event of the year, and it's going to be very timely as we move into a new year with the market sitting at or near all-time highs. So I would certainly encourage all of you to take a look at signing up for that. I will show you a screen quickly here. And just to give you an idea of where you can go to get more information, if you go into EarningsBeats.com, just to our site, and then at the very top, you will see a tab, Market Vision 2020. Go in there, sign up, get in for the newsletter. By the way, there's another mini-series event tomorrow. This is a free event to all of those who are signed up to the newsletter and, of course, all of our EarningsBeats community. But Dave Keller from Stock Charts, he is their chief market strategist, does their closing show every day on Stock Charts TV at 4 p.m., the closing bell, or right at the closing bell. Name of his show is The Final Bar. Does a wonderful job recapping the market. And he's got kind of the vision of Stock Charts TV, and he's going to come in, talk a little bit about the mindful investor tomorrow, talk a little bit more about psychology and the things you need to do to be ready for a trading day and how to approach the market and so forth. It's going to be a great talk. Again, that's just a mini-series event. That's a free event for everyone, but you do need to be signed up to the newsletter. So go to EarningsBeats.com, click on that Market Vision 2020 tab at the top. It'll bring you to this page. Make sure you're signed up if you haven't already. All right, let's move on to the market. I do like what's going on in the market. Got to admit, it continues to push higher. Let me just get an update, especially for that 10-year Treasury yield there. The Dow Jones finished up 3 points on Friday. Doesn't sound like a lot. S&P, just a quarter of 1 point. The NASDAQ, 17.5 points. And small caps actually went down on Friday. Down 6 points, almost 7 points, back close to 1,000 level. That was a big move, though, getting through 1,000. We hadn't seen that in quite a while, so that was a nice move. I think we're simply going back and testing a support area. You can see, actually, if you look up at the PPOs on the major indices, you can see that the momentum has actually slowed a little bit on the Dow, the S&P, and the NASDAQ, but we're actually starting to turn back up a little bit on small caps. So even though we had a little bit of a rougher day on Friday in small caps, I really like this group. And seasonally, the second half of December, and by the way, today's December 16th, second half of December is when small caps really do well. Annualized return over the last 32 years for the second half of December, 67%. That's the annualized return. I'm not telling you small caps going to up 67% in the next 15 days. Please don't misquote me on that. That's the annualized return. But if you take that and divide it by 24, that's 67%. That will tell you that on average, we go up probably close to 3% on the small caps between the 16th of December and the end of December. Now, 3%, that'd be 30 points from where we are. We'd be at 1,030. That's the average of what we have done for small caps for the last 32 years, dating back to 1987. Now, that's on the Russell 2000. I should make that differentiation here. This is the S&P 600 small cap index. All the studies that I've done have been the Russell 2000. So, but still, it's small. These are small cap stocks. The 10-year Treasury yield, you can see up 3.5 basis points this morning, back to 1.85%. A rising Treasury yield, we want to keep an eye on that. That coincides with very strong equity moves. If this rally continues here on the yield and we get back up above that 1.95%, I expect we're going to see a really nice rally into the end of the year and into the beginning of 2020. All right, kind of a strange leaderboard on Friday. Friday was a weird day. We did go higher. I can tell you our portfolios at EarningsBeats, for whatever reason, did not do well on Friday. I think maybe some of it had to do with the small caps moving down. I mean, there are a number of small cap, mid cap stocks that are in the portfolios. I also think that where we did see strength, it was kind of strange. Utilities led, consumer staples were third, and actually I've got real estate on here twice, but real estate was also one of the stronger groups, and that's defensive. And you can see real estate down here holding on to a key support level that we want to watch. I actually think real estate might bounce from here. I don't know if it'll be a leader because I see the market going higher. I think real estate goes up off of that candle, but it probably is going to go up less than some of the other areas of the market. That would be my educated guess going into the second half of the year. But still, as you look across here, you can see these weren't exactly the big names that we would expect to lead a rally on Friday. And again, it wasn't much of a rally, but we did continue moving up. You can see the NASDAQ set a new all-time high. Same with the S&P 500. Dow intraday set a new high. So there was some bullishness going on, but it just wasn't being led by the right groups. Looking at that 10-year Treasury yield, again, let me get the most recent here. We're up 3.5 basis points, 1.85%. But really, this October rally, or the rally since October on the S&P 500, has coincided with money rotating away from Treasuries. Very, very important to understand. It's not just new money coming in or money leaving the stock market. It's also rotation. Money rotates from more defensive asset classes to more aggressive asset classes. They go back and forth. So when the economic, when we look out at our economic picture in 2020, if traders believe that we're going to strengthen, they're going to want to get out of Treasuries and they're going to want to be in the stock market. And so that's what we need to watch as traders to make sure that we understand this rotation back and forth and where we are in the cycle. Right now, we are seeing rotation out of Treasuries. Now, I've said before, I think that the 10-year Treasury yield could go down and we could still go higher in the S&P 500. And the reason is if you have a reasonable amount of growth and you have no inflation or little inflation, there's no pressure on the Fed to raise rates to potentially begin to squelch out or, to have some folks taking money off the table in terms of owning stocks and so forth. So that's really nirvana for equities, is to have an environment where you're seeing growth with no inflation or little inflation below the Fed's target level, because that actually could lead the Fed to lower or certainly not to raise. And so that could still be a possibility as well. So if the 10-year Treasury yield rolls over, we need to make the determination, is it because of the economy or is it because inflation expectations are lower? That's a big difference with how the S&P 500 will trade. And I've wrote about it many times. I actually wrote an article on Saturday in Trading Places. I'll show you that real quick. And I would go back and read this if you haven't already. It's just my opinion, but I wrote about this a year ago, saying that the Fed was making a lot of mistakes. And I went through the whole year and laid out why I think that the problems we had when we did have big drops in the S&P in 2019, I laid out my argument why I think it was more the Fed than it was trade war. But anyway, you can go back in here and read this article if you'd like. All right, I got a couple charts I want to show you here. First, economic reports. There was one out this morning, December Empire State Manufacturing Survey. Came in a little bit better than expected, 5.3 versus 4.0. We do have the December PMI composite flash. That will come out at 9:45, so it'll be out in about 35 minutes. Expectations there, 52.4. December Housing Market Index, the expectation is 70, and that will be out at 10 a.m., so in a little less than an hour. As I mentioned, the 10-year Treasury yield is up a few basis points today. Maybe it's a reaction to the Empire State Manufacturing Survey. I mean, it's possible, but I think more of it is just rotation. I think that it's traders looking at what's going on in the stock market, and there's some intentional rotation out of Treasuries. All right, let's take a look at a couple of charts here. I do want to mention that crude oil on Friday finished back above $60 a barrel. First time we've seen that in almost 3 months, or just about 3 months. And you can see that was very short-lived. Really, we haven't had a sustained move above 60 really since back April, May. So with crude oil prices moving up, you can imagine that energy is not doing too bad. It did come down on Friday. I suspect we're going to go back higher on energy just because I believe that crude oil is going to move higher in time. I think the dollar, I think now that the Fed has finally figured it out, and I say that with a lot of sarcasm in my voice because these people are supposed to be really bright. But I think they finally figured out that with low inflation expectations, that their hawkish policy was simply doing nothing but adding fuel to the fire. It was keeping the dollar high or higher than it should have been. And as a result, it was putting more downward pressure on inflation. So I think that we're going to see the dollar begin to weaken at some point in 2020. And we already have seen that to some extent. I'll pull up the dollar here for you. You can see right here, it's been pulling back. I talked about this a while ago, and there's a chart that I like to follow. It's the difference in the 10-year Treasury yield here in the U.S. versus Germany. And when that's rising, then the dollar usually goes with it. But when it's falling, we got to be careful on the dollar. Well, it started falling back earlier, probably over the summer in 2019. I don't know if I have that. Let me see if I can find that chart for you. Yep, here it is. Okay. So actually it was started, I said the summer of 19. It was actually a longer time ago. It was a year and a half ago, or a year and a quarter ago, back in October of 2018. But here's the difference in the Treasury yields versus, here in the US versus Germany. So when it's going up, it coincides with the dollar going up. Well, the dollar going up is going to put downward pressure on commodities. Well, I put these red shaded areas in here because there are times when these two go in opposite directions. Here you can see the 10-year Treasury yield in the U.S. going up versus Germany, but the dollar actually went down. So we had an inverse correlation, which is unusual. You can see this doesn't happen very often, but it happens in these red shaded areas. And what we saw when we went up in the yield here in the U.S. versus Germany, went down the dollar rallied back to get back on track from a correlation perspective. Same thing happened in 13 and 14. U.S. economy was showing more strength than Germany, so the yields were going up faster. The dollar went down for a while. Negative correlation. The dollar comes surging back. Go to 2017, 2018. Here you can see the Treasury yields going up faster in the U.S. Dollar kept going down, though. Inverse correlation. What happens? Dollar rallies back. Well, for the first time, we've got it going the other way. The dollar was going up, and the strength in the U.S. economy relative to the strength in Germany has actually gone the other direction. So that's one of the reasons why I've said I'm a little bit more bullish about global markets in 2020. I like the U.S. market, but I might like some of the others even better. Some of the foreign ETFs where you get a benefit when the dollar is weaker, they starting to look more attractive. They haven't looked attractive in a long time, probably in 8 or 9 years, but they're starting to look more attractive. But this, with the dollar going up, look at this. We actually had that inverse relationship again. So I think we got to be cognizant of the possibility that the dollar now is going to move lower. And when I go back to that 1-year chart, that's exactly what we're seeing. We're seeing the dollar starting to roll back over again. Well, if the dollar goes down, that helps to lift energy. It helps to lift materials. So those areas that have been underperforming for a while, we might actually begin to see some outperformance from those groups, or at least going along for the ride. They've been underperforming the S&P for 8 years, since 2011. We may actually start to see energy and materials begin to perform much better on a relative basis. So I wouldn't be as bearish on those groups. And if I traded only the sector ETFs, I'd probably want a little bit of exposure to both the XLE and the XLB going into 2020. It could reverse. I mean, we could see the dollar take back off again, but I don't think so. I think the dollar is probably going to move a little bit lower in 2020, and I think that could set up a decent year for energy and materials. As far as some of the individual materials go, let's take a look at gold. Gold has an inverse relationship to the dollar. So if the dollar is going down, gold should be going up. But you can see gold really hasn't reacted too much to the upside with the dollar going lower, and that's a little surprising. I'm not a huge long-term fan of gold, but on the weekly chart, I would watch 1450. That was an area where we broke out from here. We went up, consolidated for a month, and then broke out at 1450. We've come back down, consolidated for a bit at 1450. Now we're trying to move back up. I think if I'm right about the dollar going down, gold could make its way back up to the 1550 area. All right, silver. I'll stick with this longer term weekly chart. Silver hasn't been as strong as gold. You can see certainly the last 3 or 4 months, not very good, falling from over 1950 back to the 1650, 17 area. I think the 50-day moving average in this area around $16, though, is a pretty good support area on silver. So this is one that I would expect is also going to reverse back to the upside. Copper is probably the one that I think could be on the biggest move to the upside. I really like this move. I think the falling dollar is helping, but I also believe we're going to see economic improvement globally in 2020, and copper is the one that is tied most closely to our economy. So copper is one I would keep an eye on. I think that this breakout right here to multi-month highs is significant. I think initially we'll go up and threaten this $2.95, $3 level. I think we're going to eventually go through that, though. All right. Earnings. Let's talk a little bit about earnings. Got a number of reports coming in later this week. Well, there's probably maybe 55, 60 reports out this week, but several of them are pretty good size. I'm just going to say market cap's 1 billion or greater, but many of them are over 10, 20 billion. It starts off later today, one company that will be reporting, and I'm going to go through these pretty quickly. HEI, this is a company that reports later today. I'm going to show you on a relative chart. I try to maybe get a gauge on what I think a company might do with its earnings based on how it trades on a relative basis in the 3 to 6 months heading into its earnings report. Well, HEI has been sideways versus the aerospace group. So very difficult to really make much of a call. You can see the volume trends were weak back in August and September on the selling. We've rallied back a little bit, but volume was just kind of so-so. I don't know. This is a coin flip to me. FedEx, I wrote about this one this morning in the EarningsBeats Digest, which is a free 3 times a week newsletter. So you can go in and sign up for the EB Digest newsletter if you'd like. If you're not already a subscriber, it is free. And it, like I said, comes out 3 times a week, Mondays, Wednesdays, and Friday mornings, usually concentrated on earnings-related and relative strength-related topics. So a lot of companies that have either reported earnings or are about to report earnings, I like to focus on these. So FedEx, you can see the stock has come off the bottom recently in October. Volume trends, though, maybe they've improved a little bit over the last 2 months, but that was a lot of selling and distribution that took place in October. We're starting to see a little relative strength here over the last couple of months, but the overall trend is down. Also, the group itself, we have not seen a breakout yet. And so a move through about 1025 or so, I think would be bullish for the group, but I think it's going to need a good report from FedEx to actually make that breakout. CTAS, this is another one that reports tomorrow along with FedEx after the bell. CTAS, big sell-off here in November, but it put in a hollow candle. That, even though it was going down, I think there was accumulation. Look at those two back-to-back. Hollow candles finishing near the highs with some pretty good volume. We've held on to the lows back here in September. Gap support from July. I would say gap support from July is probably the biggest level on this chart, which is all the way back down around 236, 237. So that would certainly be a level I'd watch. I think this one is a little bit better than FedEx, though. It wasn't, but about a month and a half ago, we were at a 52-week relative high. Now, we have come back down, but it's happened during consolidation. This could be a cup off of an uptrend. I like CTAS better than FDX. If I had to hold one of the or the other into earnings, it would be this one, CTAS. But I don't have to hold either, so I'm not. JBL, Jabil Circuits, or that's what it used to be. Now it's just Jabil Inc. Pretty nice looking chart. Look at the relative strength here. This is one I would like heading into earnings. I'm not somebody who likes to hold stocks into earnings, but if I was going to hold stocks into earnings, it would be a stock like this that's been trading very strongly. Wall Street goes out, visits with management. Obviously, they're liking what they're hearing. So unless Jabil is going to, really drop a bomb on Wall Street, I would expect the numbers here to be pretty good. Some others reporting later this week. Micron reports on Wednesday. I think that one's worth mentioning. Trying to make this breakout right now. Semiconductors have been on fire at all-time highs. Micron, it was in the doldrums back in the first half of 2019. It's rallied back in the third quarter. Fourth quarter is just kind of going along, sideways. There have been some great reports coming out of semiconductors, though. I would, again, think that we're going to get a good report out of Micron, but that's, I'm not going to say nothing. I would never say 100%, but I'm thinking like, maybe 65% sure that they're going to come out with a good number and possibly a nice gap higher, but it's nowhere, definitely not a guarantee. Nike reports later this week. Nike, you can see breaking out. On a relative basis, though, there are other footwear stocks that have been doing better. When I look at the relative strength, a lot of selling back here in October, and the rally has been on much lesser volume. So, yep, it's at a 52-week and I think all-time high, but is it going to report a great number? I don't know. This one, I would, again, be more 50-50 heading into earnings. And then I want to mention one other because this is the first one of our portfolio stocks at EarningsBeats that's going to be reporting. This will be on Friday. CarMax is going to be reporting, and CarMax on a relative basis to the specialty retailers remains very strong. I suspect they're going to have good numbers. It is in a trading range right now, 100.5 to the upside, maybe 92.5 to the downside. I would suspect we're probably going to open in that range somewhere. It would be very bullish to get a good report, though, and gap above. That's what I would look for later in the week. All right, let's talk a little bit about upgrades and downgrades. Citigroup, a number of upgrades today on many financial stocks. Let's just take a peek at a couple of these. CFG, this is Citizens Financial Group, looking pretty strong. It's been moving higher. Relative strength's been building the last month and a half. Not one of the best banks out there, but it's improving. I like some other banks better, but I can understand the upgrade here. It certainly is broken out and is starting to look a little bit better. Goldman Sachs upgraded from neutral to a buy. Price target here raised 220 to 255. I said the other day when we got a breakout on Goldman Sachs, I like it. I think overall, relative to the investment services group, I think it held on to a key relative support level. Starting to move back up. I would not be surprised to see a breakout in terms of relative strength. Here with Goldman Sachs, I like the volume trends. You can see the big volume days that stick out are all positive. Just broke out to new highs. I agree with this upgrade. I like Goldman Sachs. Northern Trust, NTRS. This was one I actually considered for the income portfolio at EarningsBeats. It's on the strong earnings chart list. I really like the way the volume was shaping up here, moving up. Relative strength here, relative to asset managers is strong. I can't disagree at all with this upgrade. It's, moving up, probably getting a little overbought. This has been a big move for a stock like this. So we might see some consolidation, but I believe in time we're going to see higher prices. Regions Financial also upgraded, starting to show some nice strength. A lot of sideways consolidation, breakout, higher low, breakout, higher low, breakout. This is what you want to see. Relative strength versus banks. Again, I like JP Morgan. I like PNC. Those are two banks I really like right now that I would have over something like Regions Financial, but it is definitely improving. So I'm okay. I'm good with this upgrade. Last upgrade I wanted to just mention, Citigroup upgraded USB from sell to neutral. Well, it's nice that they finally went. I don't know when they had a sell rating on it, but it's been going straight up for the last 2 months. So it's probably time to move it out of sell. Again, like Regions Financial, I don't think it's one of the best banks. I think there are others, JP Morgan and PNC, just to name two, that I like better. But it's breaking out. It's likely to outperform the S&P 500 because it's in a good group. I think there are better stocks, though. All right, let's see. got time for a couple downgrades here. Morgan Stanley, while Citigroup was out doing a lot of upgrading, Morgan Stanley was doing a lot of downgrading. So let's see what they downgraded. Pepsi. Don't like this downgrade at all. I think sodas are looking good. I'm expecting a breakout here of the software or soft drink group. If it does, the one thing I would watch the downside, watch this relative strength. If it were to fall back down below this level and continue this overall relative downtrend, then I'd be a little bit more concerned. But I think most of this downtrend that you see here has occurred while the group has been consolidating. You see that a lot. I would be much more concerned if we were breaking down in soft drinks. We have not broken below the key low. So I think we're consolidating and going to break out. So I think that this downgrade is an opportunity to jump into Pepsi. Cheaper prices, I expect we're going to get the breakout. PGR, Progressive, Morgan Stanley downgrades them from the same as Pepsi, from overweight to equal weight. And the price target here on Progressive is $74. Now, if you're downgrading the stock and you still got a target above the current price, not really. Maybe they think the market's going to go up a lot faster than Progressive getting back to 74. I don't know. But the stock has been downtrending. You can see on a relative basis, it is not a leader. So I'm okay with this downgrade. I do think that the stock is probably just mired in a period of sideways consolidation. Gap resistance up at around 75, I think, is going to be important to watch. To the downside, 68 recent lows. I think as long as you're in that range, you're okay. If you were to break below 68 again, I think that would be a very bad sign, especially given the relative weakness in the stock. All right, let's look at the 3 you must see to wrap up today's show. I do want to mention before I get into this that futures are higher today. Currently, we've got I'll give you the latest. The Dow right now is up 71, the futures, S&P 17, NASDAQ 53. So it does look like we are going to have a pretty good start to today's action. And as I mentioned earlier, this is the start of a very bullish period, especially once we get toward the latter part of this week. From about the 19th through the end of the year, there's generally a very strong tendency for prices to rise. Some say the Santa Claus rally is from Christmas to New Year's. I think it starts earlier than that. I would actually call the Christmas rally from about the 20th through the 31st. All right, let's take a look at these 3 that you must see. So I'm going to start with just a pattern that I like to trade. This is a stock came out with pretty good numbers, earnings, gapped up. You can see it gets up to resistance, comes back down, and this pullback, look at the lighter volume. Anybody buying at 15 or 15 and a half gets spooked out when a stock gets back down to 12 and a half in 3 or 4 days. If you buy a stock at 15 and it's 12 and a half 3 days later, you're going to think, oh my gosh, this is a horrible stock. I better jump out. So you jump out and then it comes back up. The time to get into a stock like this, when it gaps up and moves higher, I like to try to have patience. Top of gap support here, just above 13, and this tail intraday with a lot of sellers coming in, that's where the buyers stepped in. So that also provides really good support. And look at these lows, get right down into this range. And then all of a sudden, the stock's up 9% on Friday. Have some patience with your trading. So SCWX is chart number 3. Chart number 2, AVGO. This is Broadcom. Look at the breakout here with earnings last week. I think that's significant. Yes, we came back down. I still think, relatively speaking, first of all, you got the semiconductor group going up. I think as long as it holds this breakout area right in here and the 50-day moving average, I think AVGO could start to show some relative strength and move back to the upside. So I like AVGO. I would continue to watch 300 as support. Final stock today is JCI. Johnson Controls. This one's going in the other direction. Look at the volume pick up. And it had a lot of support on many occasions between about 40 and a half and I'm going to say 41 and a half. So that was holding. We had a double top in play. So you don't want to lose support. We lost it on Friday. JCI is one I'd be very careful. Could it come rallying back? Sure. Stocks can do anything. But I think when I start seeing support being lost on heavier volume, That's when I grow very cautious, keep my stop in place. If I owned the stock, I would have been stopped out on Friday. I would not take a chance on a stock that looks like it's beginning to start a downtrend. All right, those are your 3 you must see today. Again, check out Market Vision 2020 over at EarningsBeats.com. Everybody have a great week, and I'll be back here on Wednesday at EarningsBeats. Happy trading, everybody.